The growth of AI fueling those big investments with venture capital firms pouring into the space. U.S. fundraising climbing to about $80 billion in the fourth quarter of 2024, according to PitchBook. Joining me now, Kyle Stanford, PitchBook's senior venture analyst. Great to have you here, Kyle. I want to start on this CoreWeave IPO in particular. I wonder to what extent you think that CoreWeave's IPO is indicative of a broadening and a revival of activity in the IPO market.
Yeah, that'll be tough, right? I think CoreWeave obviously is has a great company. They have a great model. They've grown incredibly fast and raised a ton of money. I don't know that they're necessarily going to be an indicator for the IPO market for other companies, right? We're really seeing a bifurcation in the activity in the deal-making space, where you have AI raising about 50% of the capital, and that $80 billion, $10 billion of it was to Databricks. The rest of the market is having a still really hard time raising capital, finding the funds they need to continue growth. So it's becoming a very different market than I think the resurgence from the data perspective would show.
Kyle, talk a little bit about the kinds of venture capital that's been backing businesses like this. CoreWeave, backed by NVIDIA. That's one public company that does invest venture capital from its balance sheet. Salesforce is another. Do you think that those kinds of big public companies backing startups creates halos around some versus others?
Yeah, if you look at across the biggest names in VC, OpenAI or XAI, they all have huge corporations on their cap table, right? These corporations are trying to keep up and become the forerunners of the AI space, and so investing in these really high growth, fast moving, great new technologies from the startup space is where they're going. So it's a much different type of investment than your typical VC, right? I mean, think about Sequoia and Andreessen, they're in that game too, but majority of the VCs are under $50 million. They're not backing these businesses, and they're kind of missing out on the, barbell effect that AI has created. So, these corporates, NVIDIA, Microsoft, Amazon, all putting money in is really going to help inflate those deal sizes because they're able to put that cash behind the companies.
Is there perhaps something sinister going on when it comes to private markets right now, given, OpenAI set most recently at that $260 billion valuation. Obviously, the sky seems to be the limit when it comes to private funding for these companies here. And then you have a trickle of IPO news, CoreWeave, Klarna, StubHub even. Is that a sign that there's some pain in private markets, that the spigot's getting turned off?
I don't think necessarily, right? I mean, StubHub is a good example, right? They've been private for quite a long time, and so continuing to raise private capital, I don't know their exact cap table, but they might not have the equity to sell, so they might be pushed into the public markets. We also need to think about the LPs in these VC funds. They need liquidity. The secondary market has gotten a lot of buzz over the past few quarters, but it's not nearly big enough to provide the liquidity to these LPs that is really needed from these VC-backed investments. So IPO is kind of the natural move for a lot of these unicorns, and whether it be OpenAI or someone like StubHub who's been a unicorn for quite some time, like that push is necessary. It doesn't mean the spigot is being turned off in the private markets. It's just the necessity to move into a different financial market institution is kind of being pushed forward for them.
Carl, let's talk a little bit about how this all translates into the actual funds themselves in the venture capital world. One of the things that we've seen is the deals have been getting bigger, but a lot of the funds have been getting bigger and bigger as well. Funds that used to raise several $100 million to $1 billion, now raising multi-billion-dollar funds. That does make it harder to get the kinds of returns on each of those bets that's going to get the sorts of fund dynamics that VCs have been used to. What's your thinking on that?
Well, I think they're going for a completely different type of return, right? If you're investing in these, ultra late stage companies and holding a smaller portfolio of these investments, you're probably not seeing 75% of the companies go out of business like you would if you were investing in seed and Series A, right? And so when you talk about, again, Sequoias and Andreessens that are really raising these multi-billion-dollar funds, they're not looking at the traditional venture market. They're investing in higher quality businesses or businesses that have at least gone through multiple funding stages. They can put on more traditional due diligence practices and really help kind of flush out the risk that venture is typically associated with. Now, Andreessen also has, and Sequoia as well, seed funds that are investing in the early stage technologies, but the median fund size is still under $50 million. And so when you talk about these large firms raising these multi-billion dollar funds, it is still, again, a very small handful of firms that are raising it compared to the broader venture market.
And then talk to me, Kyle, about what you're seeing playing out in public markets and how that might be playing into any skepticism that we might be seeing in those private markets moving forward. Obviously, a lot of volatility in the broader market off the back of tariff headlines and a slew of other potential headwinds here. To what extent does that play into venture as well?
Yeah, well, one thing that startups really hate when they're trying to go public is volatility. So, right now it's been pretty short term, a month or so of heavy volatility. That probably won't have too big of an impact right away of this IPO market. It's been so slow for so long, and CoreWeave's going out, which I think will give a little juice to the market. But I think as volatility, if it goes into a second quarter or increases more, and there's more uncertainty pushed into the market through tariffs or any other sort of legislation that is, unseen before, that's going to have an impact on companies that maybe don't have the story or the hype behind them to go public in this market. Those companies will need to figure out a way to lengthen their runway and make sure that they're ready to hold off on an IPO for 2 quarters, 3 quarters, maybe till next year. Again, the length of the volatility will have a big impact. Right now, we don't see it impacting the numbers too much, just maybe pushing some of the IPOs a few months later into the year.
All right, Kyle, we got to leave it there. Thank you so much for joining us. Appreciate it.
Yeah, thank you for having me.